thanking you for the opportunity to speak and to engage on such an important topic. I note that this is the 12th annual East Africa Property Summit. 12 years is sort of interesting to me. I landed, I stay in Johannesburg. I landed late yesterday afternoon, right towards the end of a rain squall that had come through. And my own experience of rain here in Nairobi dates to about 12 years ago. I've been coming here more than 20, but landed at Kenyatta about 7 in the evening. It was raining hard enough at that point that the baggage handlers decided they didn't want to get wet. So the first hour was spent just waiting for people to go and grab the luggage out of the plane. The next 3¼ hours was spent getting from Kenyatta to one of the traditional hotels. Astonishing. I got there just in time for the very last bit of the Champions League game. Was meant to be there speaking at an event at 7 in the evening. And so what a transformative experience, because landed, it's raining, 30 minutes later, easily at the hotel. And that same reflection, thinking over this dozen or so years, what we should have is a picture of the skylines, right? The skyline of Kampala, the skyline of Dar, the skyline of Nairobi, and showcase how that has changed over the last dozen. Because it's hard to recognize. Upper Hill doesn't look like Upper Hill did, even 5 years ago, and certainly 10 or 12. And that's down to rooms like this, right? And so whilst my job here is to, in a very dour way, talk about economics, I wanted to lead with a bit of excitement and sort of the dynamism of property markets and investment and the things that are going on here. So, into the economics presentation itself, I guess the first broad observation is that, gosh, an awful lot has changed, right? From 12 months ago to where we are now, from 6 months ago. 12 months ago here in Kenya, it was a particularly volatile and exciting time. The last 4 or 5 months in a global perspective have been quite exciting / volatile / uncertain. The graphic in front of you is looking at measures of economic policy uncertainty. The global one is in the red, the US uncertainty is in the orange. These graphs go back, better part of 25 years, but if we took them back even further from this, right, you see that it's really unprecedented levels where we are right now, right? Similar to where we were in the very early days of COVID, when we were shutting entire economies down. That's where we are, both on a US level of uncertainty and a global level of uncertainty right now. And that uncertainty plays through sort of business decisions and economies in a couple different ways. Right, as a top-down economist, we always think about economic growth, and certainly we've seen that. The IMF has released their new World Economic Outlook report just a couple weeks ago. Spare a thought for the hundreds of people at the IMF that work on this document. They typically have 3 or 4 months to put this thing together. It's a very much a lengthy bureaucratic process with the world and the news flow changing sort of almost daily. Very difficult in that space, but on a headline, the forecast that you see in front of you there for the global economy, about a year ago they had thought the global economy would grow 3 and a little bit this year. That forecast had actually improved over subsequent editions. And then whack, you take about half a point off for everyone globally. Within that space, different countries are getting hit to different extents. So the United States, over that year to where we are now, actually the economy was proving more and more resilient, right? Employment markets were remaining strong for longer. Consumer was remaining so, and that all comes to a grinding halt. In the last 2 or 3 months. We've seen European Union economic growth slow considerably. China, sort of 3/4 of a point, hacked off China's growth. And this is just kind of what we think here first order, but it's the uncertainty, that economic uncertainty that sits on the left panel, that I think was likely to weigh on us more heavily through the cycle, right? Because businesses that don't face a very certain environment find it very difficult to pull triggers on projects that will have payoff in 5 years or 10 years or 20 years. So we can easily imagine a world in which global investment just comes down and comes down very quickly in this space. what are some of the primary drivers? Well, there's an awful lot of things coming from the US administration that look significantly different than where we were before. The bit that we're kind of most focused on in the most recent period is thinking about global trade, right? This concept of reciprocal tariffs. If you are a student of economics and you wonder how much economics has changed since you left school, I promise you new textbooks don't have this in there yet, but it's a fairly simple calculation. But the broad problem statement from the US administration seems to be very straightforward. The US administration believes that the rest of us in the world don't treat the US very fairly when we engage with it. So whether you have a trade surplus with the US, then there must be something about you and unfairness that generates that trade surplus with the US, even if you run a trade deficit with the US. The United Kingdom's a great example of that. Singapore, a great example of, even then there is a sense of unfairness. And so you've popped onto the global economy all these reciprocal tariffs and of course massively higher tariffs for China. The impact of these tariffs will be different across different parts of the continent. So you will have seen on a headline basis, small country like Lesotho, landlocked in South Africa, does kind of 2 or 3 things for a living, one of which is it sells water to water-poor South Africa, but the other thing it does for a living is textiles. And it's been whacked with a 50-odd% export tariff, makes it impossible to run a business in that space. Here in East Africa, the engagement around this particular topic is at least a little bit easier. We think the first order impact of these tariffs will likely to be fairly small. Direct trade with the United States is actually pretty modest. So if you're Uganda, about 1% of Uganda's exports last year went to the US. Tanzania, about the same, about 1%. Kenya, it's about 8%. And there are some textile exports going there, so that's one of the more cutthroat competitive businesses that exist. So you put a question mark over the impact there. But what we also see in terms of mitigating the first order impact is that some production just can't be brought on shore. The US cannot produce tea and coffee. Doesn't have the right growing conditions. Tea and coffee from East Africa is still going to find its way into global markets. But the other bit that helps us here is that the tariff rate that's been impacting on Kenya, Uganda, Tanzania is 10%. It's not as good as 0, but 10% is kind of the lowest one that sits there globally, so at least there's no relative competitiveness loss. It's not the challenge of Mauritius, it's not the challenge of Lesotho, it's not the challenge of Madagascar and others. But there is still, so the graphic is just showing what countries in East Africa export to the United States. So on the clothing side, just over $500 million worth of textiles went from Kenya, largely from the factories near Mombasa, to the US last year, right? 10% tariff on that stuff makes clothing more expensive for the US consumer, but that 10% is the lowest of the reciprocal tariffs that exist. So it's not great news, but it's probably manageable. The second order impact, though, here also exists, and it's going to be a little bit unclear. The first slide talked about lower levels of certainty. It talked about lower global economic growth. Well, that reduces kind of the demand for everything, right? And so we've seen the impact of that in things like commodity markets, where if you dig gold out of the ground, this is a great time to get more shovels. But if you're an oil producer, you're a copper producer, others, more difficult environment. And something that will be very relevant for the discussions around today, I guess, would be things around sort of financing costs and risk appetite, right? So there's a broad expectation, we're going to see it in a slide or two, that interest rates ultimately are going to fall in the world, at least risk-free rates. Federal Reserve will cut interest rates, the ECB will cut interest rates, Bank of England and others. But how that translates into financing costs for riskier assets, and East African property is going to be an example as compared to US treasuries of riskier assets. How that translates across is going to be a little bit less clear. Our current expectations around economic growth for East Africa is, in fact, the changes from US policy are likely to have quite a small impact here. What's really driving, the dotted line here is our forecasts, IMF forecast for the region about a year ago compared to where we are right now. The difference between those two bits is less about what's going on in the US. It's less about global oil prices or gold prices or uncertainty, and it's more about country-specific factors, I'm happy to say. And that's really helpful, right? Because we ourselves have some control over the country-specific. So you'll see that medium-term forecasts from Kenya have been written down a little bit, but economic growth of plus minus 5% is still pretty strong. The main difference between those two things is a greater concern about debt sustainability, sort of fiscal consolidation, finding ways to do more here without more taxes, right? And we reflect on about a year ago in that space. Tanzania, economic outlook, very little change. It's really driven by very substantial investment and commitments in that space. And in Uganda, in the outer years, it's really trying to think about when oil comes on stream. So I've been traveling to the region for almost 20 years, just over 20 years, and this has been a constant query there, but very strong economic growth in that space. But if we take a step back, because this is thinking about what economic growth is this year, next year, whatever, but property is one of those things, the projects are much longer, right? The impact is much longer. This isn't a done and out. And so here I want to motivate, and I was making these slides on the plane yesterday, and I don't know that I've got the graphics quite right, but my day job is as an economist, not a graphic designer, so you're going to need to kind of bear with me here. What are we looking at? Well, the bars there, and there's sort of 50-odd bars. Each individual bar there is an African country, and that's looking at average economic growth forecast for the next 5 years. And so what is see in this space? Something like South Africa is that little pale bar very far to the left. It means that we're one of the weakest growing countries across the continent in the last 5 years. The next 5 years, we got our own particular sets of challenges, right? You'll see Nigeria not growing quite as quickly over the next 5 years in forecasts as Seychelles, right beside it. You'll see where Egypt and Ghana sit to the left, not growing as quickly over the next number of years as a place like Kenya. We go further to the right in that distribution, and you're finding not just the fastest growing economies in 1 year or 2 years, but over lengthy periods of time. And you see Tanzania, Uganda, sat right there with much different countries like Rwanda, Ethiopia. And if you're asking yourselves, well, as a property investor, surely I want to be focused on those last bars to the right that Jeff didn't even label. What's there, right? It's a different proposition altogether. 2 of those 3 bars, for example, are the 2 Sudans, right? Different proposition. Let me leave it at that. So when you're thinking about countries that are growing very quickly over long periods of time, but also grow in fairly stable ways, it's very easy to make a case for a Kenya, for a Uganda, for a Tanzania. And if I take it out of the African context, and I'm not sure whether this graph worked well, but the next one I got real challenges on. You notice the bars here got much thinner. This is across the entire world. 194 countries in that graphic, right? So let's imagine a world where your mandate is to just get on a plane and find projects. In this space, we still see, not just in an African context, but East African economies, Kenya, Uganda, Tanzania, stack up really, really well against the global alternatives. And again, think about the consistency, which isn't to say that the business environment here is always easy, right? I don't want to sound naive, but the economic growth and the volatility around that is much lower than we see elsewhere. And I've left a gap there. I didn't center this on purpose. I've left a gap for another slightly different concept, more relevant, I would think, for residential markets. But if the first graphic on that page is looking at average economic growth over this period, the second graphic on the page is just thinking about population growth. Now again, this is looking at more than 190 countries around the world. It's thinking about population growth, not per year, it's 5 years in total. But Uganda's population is expected to grow more in the next 5 years than any other country on the planet. Now, there's an equivalent here, right? If you have an airline, what do you think about? You think about bums on seats, right? If you're running sort of residential property, you must be thinking about sort of people on beds. I don't know what the exact concept is, but the more people they are, the bigger the broad opportunity. Now, it's going to be the job of people in this room to work out what market segment that's going to be in, right? but there are very big opportunities here. You see Kenya to the right of the midpoint in terms of global population growth. You see Uganda at the very peak, Tanzania somewhere in the middle. So there's lots and lots of broad sort of macro trends here that I think are very supportive. Financing conditions. Well, in terms of hard currency financing, and I can't speak to sort of the risk component of this, but I can just think about the underlying environment here, sort of front-end risk-free global rates. So US SOFR rates, the expectation is that the Federal Reserve, notwithstanding sort of the Twitter back and forth with the White House, that the Federal Reserve will be able to cut interest rates a couple times this year, probably once or twice next year. So front-end risk-free dollar rates become cheaper than they were, right? If those exposed to local currency rates, well, the great news here in the graphic, the lines at the bottom of each of these are sort of the path of inflation. And what the broad story there is that inflation, whether it be here in Kenya, whether it be in Tanzania, whether it be in Uganda, inflation is kind of at comfortable levels as compared where central banks would like it. Of course, they'd all like it lower. We'd all like inflation lower, but it's kind of at comfortable levels. And what this means is that even in this more volatile environment, global environment, we think that for countries like Uganda and Tanzania, front-end rates, bad news, probably not going to fall, but front-end borrowing rates not going to rise. And in the case of Kenya, I'm really happy to say that we certainly expect, as ABSA research, we certainly expect that the Central Bank of Kenya will be able to provide some accommodation, make financing projects here a little bit less expensive as we go further into the year. And then my very last content slide is just around FX, right? So for those of you looking to invest locally and need to get out there, what are the observations in this space? First graphic is looking across the major currencies of Africa and asking what's happened in the last 12 months. So bars to the left means the currency has lost value, right? If you're thinking about transitioning your local currency receipts back into hard currency, in Nigeria's case, over the last 12 months, you got to run just to stay in place, right? Nigerian currency's lost 13% of its value against the dollar over the last year, but you'll see that Kenya shilling actually appreciated somewhat, about 4% over the last 12 months. You see that Uganda shilling doing roughly the same. Tanzania a little bit weaker, but by and large, none of the extremes that we've seen elsewhere. And then looking forward from where we are now to the end of the year, I guess the broad takeaway is the movements are actually against the dollar pretty small. And this is in a context when the US dollar is moving big amounts globally, right? So we expect that the shilling will appreciate a little bit. We expect that, Tanzania shilling. I should mention the country, I suppose. So Tanzania, small appreciation from where we are. Uganda, small depreciation. And I don't want to get myself in difficulties with our regulators. I would say in Kenya, 2% move, what's 2% between friends, right? It's modest amounts. It's modest amounts, and that's the broad story here. Against the dollar, we don't expect big FX moves in the region because the economies are growing stable. The direct exposure to the US and some of the chaos that's going on globally is a little bit more modest. And that's really kind of where I wanted to leave my comments, right? There's a lot of uncertainty out there globally, and that's going to impact on investment decisions and maybe some funding costs. I hadn't touched upon it in the slides, but development assistance isn't just going to be under pressure because of the announcements on USAID and the impact that that may have in some local markets that we have here around sort of expats and others. But let's take a step back, right? The US may be making these announcements for very political reasons, but you would have also noticed that the UK government has announced that their development assistance into Africa is going to taper somewhat over time as they need to repurpose some of that money to build defense budgets. The UK has been transparent about that, but they cannot be alone in that space. And I would also argue that as we look forward to the day when armed conflict in Russia-Ukraine comes to an end, the reconstruction of Ukraine is not 100 billion euros or 200, it's some enormous number. And some of that money is going to be coming out of development budgets elsewhere. So this is going to be an issue with us for some time. and we talk about debt sustainability and others, but the real strengths, right? Relatively friendly on US tariffs, right? We'd rather not pay the 10%, but other people are likely to end up paying a whole lot more. Here in East Africa, the near-term benefit from lower oil prices, should see it at the pump, right? That's more money in the hands of businesses and consumers. It's lower electricity, it's less pressure on electricity prices and others. We've seen over the last number of years, we expect it to continue, sort of this focus on long-term investment, on infrastructure and others, should hold the region in a good place going forward. And then this concept just around the fast-growing domestic markets, right? That's those charts looking at East Africa versus the rest of the world, thinking about economic growth, thinking about population growth and others. So I hope that provides a useful flavor. I've already overspoken by a handful of minutes, but I look forward to engaging over the next couple of days and learning much from the panels.